Well, good afternoon, investors. Welcome to our first bull session of 2025. It's good to be back. Happy New Year. I think we can say that for one more day without getting in too much trouble. This is our first gathering of the new year. My name is Mark Robertson. I am founder and managing partner of Manifest Investing, and we've been having some fun doing this for the last few years. I'm joined here by my dear, esteemed colleague, the magical mathematician from mid-Michigan, Ken Kavula.
Oh, we're back to that introduction again, aren't we? Okay.
It's
Hi,
okay.
everybody. Glad to be here in another fiscal year. That makes it really good.
Yeah, just something about that calendar turning over, even though we all know it's just another day. It is something that carries a lot of traditions. We are also joined here by our special guests in the back room from Indiana/Florida, Kim Butcher. Good afternoon,
Hello.
Kim.
Hello, everybody.
Now you're in the warmer location, not the icebound, snowbound location?
I'm in the warmer location. It was 55 this morning, but I think back in Evansville it was like 22.
Yikes. Yeah, we were in the teens. And then
The low teens.
low teens. And we also have Houston's Matt Spielman joining us. Good afternoon, Matt.
Good afternoon. Happy New Year, everyone. No tax guilt or tax overhang for you to avoid those sales of things you didn't want to sell last month.
Yeah, seems to have been plenty of that going on, and the market's been kind of crazy the last few days. I'm sure we will talk about that a little bit. We are going to cover a few things. We continue to monitor for our $5 million moment with our tin cup demonstration portfolio. We'll take a look at that. Going to briefly talk about 2024 in review. The topic and theme quest, that's just a solicitation. What do you guys want to hear more about? What do we need to explain better or again? And you can send any suggestions to either Ken or me. Those emails will be coming here in a second. And then last but not least, yes, the Lions continue to do pretty well this year. And I'm not able to put away the tub gate for another year yet, Ken. So ask Natalie.
Well,
Natalie
I
looked the
hope
other
we
way.
can. I hope we can keep that thing out there for 3 or 4 years here, Mark. I don't want you to put it away. So
That would
it's
be
really
great.
nice to have a team you can really root for in the postseason.
We'd be kind of pruny after that amount of time, but
Yep.
we can handle that. And the
Hey,
hour.
Mark, I want to get in a quick save the date kind of a thing near the end
Sure.
of January. The Mid-Michigan chapter is going to do a series of 3 classes for true beginners. We're going to start with a core SSG and then show how you can convert that core SSG to a good solid SSG plus. And then we're going to talk about how you can begin to create a brand new portfolio, what you should be looking for, what you should maybe be doing, and kinds of things that we think you might start to avoid as you're putting those things together. So we'll be putting it up on our webpage, and we hope to attract some folks from outside our area to the class. It's for the true beginner. We're not going to turn anybody else away, but some of you will know almost everything we're talking about already, but we're getting a lot of questions about could you run those kind of classes for us up here, and we're going to try to meet that need for them.
Sounds good. It's always a good thing to revisit, even for an experienced investor. You can pick up some ideas or some nudges that might cause you to rethink something. It's not just for beginners, but it's held out as being for beginners. And I'll pile on, Ken. I'm sitting around the hot tub in Florida this past week. I was exposed to a number of people who wanted to get involved in investing, and I'll just capture it by saying they would have been very comfortable with either Reddit or Robinhood type activity, and they were talking about investing in some really weird stuff. And I think I was able to at least get them to back up and think about doing that with only a portion of whatever they were going to commit. So it's a never-ending challenge.
It's always one of the biggest challenges when you bring new members into an investment club, and we've been doing an awful lot of that in the 3 clubs that I'm involved with. And you bring those new members in, and they want to do wild and crazy things, and they don't understand why the rest of the membership kind of looks at them and says, "What the heck are you trying to do to us?" You know. So it's a journey. It's a journey that definitely needs to be taken if you're going to be a true long-term investor.
All right, let's get a few of the things out of the way. Oh, by the way, we here's our weekly tribute to our Portillos. They are not a sponsor of the session, but they should be. I am celebrating a bit of a Santa Claus rally. You can see that on the far right with the stock went from $8 up to over 10. So we will accept that recovery with open arms. And thank you, Santa. This is okay. It's okay for it to continue. All right. Here's our standard disclaimer. No investment recommendation is intended. This is entirely an educational demonstration. It is intended to convey an understanding or what we have witnessed over the years as far as the philosophies, methods, and techniques of the modern investment club movement. Basically, we in this community believe in identifying excellent companies and buying them when they're on sale. And what we seek to do here is to share some observations about how those methods have worked for what is now virtually 8 decades. So you'll hear our interpretations and recommendations, chew on them. They are our opinions, but please do your own review and analysis of any company before actually calling your broker or punching a button, which results in an investment decision. If we own something, we will try to remember to disclose it. I do own shares of Portillo's, and they were bought higher than they are today. So anybody who consumes hot dogs or buys stock are appreciated. But again, it's up to you. Make your own decision.
You're getting a reminder from our ever aware audience, Mark, that you're above 10 is very short lived. It's down 4% today, and you're now under $10 again. So.
Oh, I'm not even going to comment. Can't do it yet. All right. So if you'd like copies of these slides, or if you have follow-up questions, or as we said, suggestions for any future topics, we are literally all ears. And our 2 email addresses are there at the bottom of the page. Anything else we should add, sir?
No, I think you did a really good job. I love that last paragraph on that disclaimer that you don't normally see, but it just says that we think you're smart enough to make your own opinions and we're not the boss of you. So I think it encapsulates what this whole disclaimer stuff is all about, and just follow it, folks. Don't tell us you did something we told you to do, because we're not telling you to do anything. We're suggesting ideas. That's it.
All right. So here's our look at the markets, Ken. We did calm down and basically end the year right on the blue line, basically. And it was a good year. It was a challenging year in many respects that we'll talk about. Value line has returned to a return forecast of 45% over the next 3 to 5 years. So that actually mathematics out to about a 9.7% rate. So again, we are looking at return forecasts for the average stock in the 8 to 9 to maybe 10% range. So let's call it 9% for now. The average stock out there is about 9%.
And Mark, as you use the Y charts data, are you noticing that it's becoming a little bit more optimistic than it was, say, a month ago, or is it basically staying in pretty much the same territory?
There has been a slight inflection, not only at value line, but with the analyst consensus to the upside. And hopefully they can keep their heads about them and not get carried away again. But there has been a little bit, that you can see just a little bit of a wrinkle to the upside on that forecast trend on the chart.
Yeah, it's obvious, and that light green line is representing the first week in January now, right?
That's correct.
Okay.
So we're right there. So we'll talk a little bit more about what happened in 2024, but it was a good year, basically the best year, at least in a back-to-back fashion, since 1998. So pressing on. Here's just a look for perspective on what can happen to the market. In this case, the market is represented by the S&P 500. And actually those down years are relatively rare, and there's a whole lot more green than gold on this chart. And those gold negative years have become a little bit less frequent here in the last few years. Knock on wood, I think. All right. So Ken, here's a paragraph from that article. We've been talking about this for quite some time. Our best small companies center on this theme. I still believe that you can see we're basically behind where we were almost 5 years ago, and well, 4 years ago anyhow, with the smaller companies. And there are some good small companies out there with pretty solid fundamentals.
I listened to a really interesting discussion yesterday, I think it was, Mark, about how the presence of tariffs might actually be a big boost for smaller capitalization stocks too, for smaller stocks in general. And the thesis basically was that most small companies didn't have supply chains that moved outside the U.S. They were fairly localized or regionalized in their supply chains, and the tariffs weren't going to have much of an impact one way or another, no matter what they were or what kind of product they were on. And that the people that were professing this idea were pretty solid about the whole thing. Our friend Tom
Lee.
Right? Our friend Tom Lee was on the panel, and he suggested that that was a perfectly valid reason to look at small caps, but he felt that it was the small caps, just like this snippet suggests, that it's just their time as well, that that we've seen this rotation go on many times in history, and he feels that the small caps are poised to grow their earnings much more quickly than most of the large cap techs are going to be able to do in the coming year or two.
Yeah, and this is a very credible source here. This is a group of institutional investors who definitely know what they're doing when it comes to smaller companies, Janus Henderson. So they have an ETF that you can actually do some looking over the shoulders of them. So I consider Mr. Pinto to be a pretty good source. The other thing here, Ken, they keep bringing this stuff up, and I think we showed fairly convincingly that the effect just isn't as big either to the upside or to the downside than most of them think. So it's probably not the biggest effect. I agree with you on the tariffs, because that is a kind of a leveling of the playing field for some of these smaller companies.
Yeah, I think it's when we look at the kind of small companies we look at, we don't expect to see a whole lot of debt in some of these high quality small companies. So if they don't carry much debt, then the amount of interest they pay for that debt is relatively inconsequential in what's going on in their business. It's very common for us to look at these high quality small companies and see zero or single digit debt numbers.
Yep.
So I agree with you. I don't think that's as big a deal for a lot of the small caps that we're interested in as this would suggest.
Okay, let's go ahead and flip to, we'll call it Index Central. This is the performance of the major indices over the last year. Basically what you're looking at, here's a collection of different indices which have different market cap characteristics, and they are all since December of 2023. So you're looking at a 1-year chart. You see the cost and the price at the close of the year just a few days ago before the ball dropped in Times Square. And what you see here is, again, we center our efforts on the Wilshire 5000 as being kind of the yardstick that we measure against. And again, that is one of the market cap weighted indices. But this 23.8 achieved last year is what you see right here. Anytime you see us refer to the benchmark, we're basically talking about this number right here. So what this illustrates for us is the Magnificent Seven is not a myth. The S&P 500 and the NASDAQ Composite are dominated by those large companies that did extremely well last year, and they were hard to keep up with. There's no two ways about it. You can see that some of what we were just talking about on the previous slide, the Russell 2000 growth, that would be some of those smaller companies for the most part. The medium-sized companies represented by the mid-cap index also were off nearly 10% more than they achieved a 13.5% return, but again, that trailed the general market by about 10%.
Yeah, even holding 2 or 3 of the Magnificent Seven didn't guarantee that you were going to have market-beating returns because they didn't perform as a unit per se. And I think, Mark, that if you were returning high teens or anything above the high teens, that you should pat yourself on the back in a year when Wilshire is growing at 24%. I think that you managed to keep up with the market fairly well, and that means that your portfolios probably will beat an average market or a below average market as you move year to year to year.
And we were talking a little bit earlier, this is the time of year when the institutional portfolio managers sit down with the boss, and the boss asks them, well, why didn't you keep up with the Magnificent Seven and all that kind of stuff? And their job is literally on the line. So we don't have that problem with our personal portfolios or our club portfolios. So we can afford to be happy about a 19% return while they're gnashing their teeth.
Absolutely.
And there's nothing wrong with any of these, by the way, long term. So it was a hot market. That is demonstrated there. So again, the Wilshire checked in at nearly 24% for last year. And the value line arithmetic average, we're going to talk more about it, but it's quite a mystery as to why that is lagging as badly as it has. So here you go, Ken. One of your favorite charts. We apologize for using a Christmas chart, but it is still the Epiphany season as of yesterday. So we are allowed to continue to do this. I think yesterday or today is the day to take down your Christmas tree, so we can still get away with this. What do you see?
Well, our tree's staying up until this coming weekend here, but other than that, this is a 1-year chart, and to be honest, I like the 3-year or the 5-year chart even better because it shows people that if you're willing to hold over longer periods of time, your chances of having a negative return reduce themselves significantly. I think Mark's going to show a chart that shows a 10-year return on a different index in a little bit, but this is still pretty exciting stuff as far as I'm concerned when you look at the number of positive years that the value line arithmetic index has had and compare it to the number of negative years. This chart goes from around 1940 or so, and 1940 kind of marks the beginning of the modern SEC, the beginning of modern rules for stock trading and for securities in general. And that's when we feel that the modern stock market actually began too. So you don't see a lot of the things happening in the older time periods. The Great Depression's not on this chart. The depressions from the 19th century aren't on the chart. But for us in our own history, there's a lot of positivity attached to this kind of a chart. And when you start looking at 3-year returns or 5-year returns, the number of those boxes to the left of the red line that Mark drew becomes smaller and smaller and smaller and smaller. So it's a great chart. Maybe in coming weeks we'll show you a 3-year chart and a 5-year chart, and try to convince folks that it's not all a bad thing to hold stocks for a long period of time. That in the long run you probably win out over a lot of other styles of investing.
A couple of things here. This is the value line arithmetic index. So what it represents is what we refer to as all of the above investing. That means that all of the S&P 500 companies are in here, and another 1,200 medium and small sized companies to make up the value line 1,700. The other question that we often get is, what are the greens? The The greens are the year following a negative year. So for every green, you should be able to find the preceding year to the left of that red line. And yeah, I see an awful lot of green boxes if we were talking about, well, in 2022, we talked about the fact that this landing here was probably not the worst thing as far as looking forward. And you see 2023 piling up right there next to last year's result. So good stuff. Here is a look at what Ken was just describing. It is the value line arithmetic average, Ken, so it still is all of the above investing, but I think it's a much more comforting way to look at it. It's a better perspective for long-term investing.
Yeah, for those of you that have graph problems or math phobic and just turn yourself off when you're trying to figure out what a graph is telling you, if you look at that very first bar on the graph, the one above the 1990, and you say to yourself, what would happen in the 10-year period that ends with 1990? So that would be 1981 through 1990. Count them on your fingers. That's 10 years. And the annualized rate during that 10-year period looks to be above 5%. And then you can read every single bar that exact same way. There was a pretty good hiccup back in 2008. The 10-year return didn't just barely nudged itself over 4%, but that seems to be a real outlier in what's going on. And most recently, Mark and I have always talked about this long-term returns for the stock market at somewhere between 9 and 11%, depending on how you measure it. And these last 2 years certainly are bearing us out, both of them coming in somewhere between 9 and 11. In fact, the last 3 years are between 9 and 11%. So that's the long-term average. And whether you're looking at the S&P on a graph like this, or even the Dow on a graph like this, you get kind of similar shapes, kind of similar things are happening, maybe not to such a degree as you see in some of these years, but the fact that there's a lot of positive compared to a very little negative for long-term trends should give a lot of feelings of warm and fuzzy to long-term investors, and it should help you sleep at night and maybe remind you that you have to kind of find a way to cancel out the day-to-day noise that comes from the investing gurus, whether they be in print or whether they be on radio or television or even coming from people like us on webcasts, that there's a lot of news to fill, and you got to say a lot of things to fill that time. And sometimes you say things that are diametrically opposed to each other. But overall, the trends are normally pretty positive for the market.
Yeah, and the last thing I would add is we keep talking about this current condition / mystery for all of the above index, the value line arithmetic average. We're not making this up. Going back nearly, well, call it 40 years, you're talking about approximately 12% per year on average versus this 10 down here. So you're talking about +2 +2 percentage points just by investing in small, medium, and large. So this chart can actually be used to support that concept also. All right, anything else here, Ken?
No, I really like this chart. I always have, and I'm not especially fond of this one because it's so comprehensive, but it's full of pretty colors. So.
It does come from Visual Capitalists, and they do some great work. You can see that the S&P 500 did actually end up in the next bracket over compared to the previous slide with that 23 or 24% performance. And the experts, most of whom will be wrong, are basically looking for 10 to 15% this year for 2025. We'll see. And you just see some fairly optimistic thinking overall. I just get a big kick out of it. If you study this chart, we were talking before we came online, look at all of these numbers. And again, this is why Benjamin Graham and Arnold Bernard the creator of Value Line, they both referred to it as investing back in those days was the OK Corral. And that's exactly why Benjamin Graham started his work, to try to make a little less chaos out of the madness. So good stuff. And it is an interesting chart. 151 years.
Yeah. Government's not always bad, and that regulation that was put on the stock market at the end of the 30s, right at the beginning of the Second World War, that regulation that was placed on the stock market has really served investors pretty well. It's kept things reasonably honest. It didn't stop the 2008 decline, but it did temper a lot of the madness that was going on in the stock market. You can see just year after year of consecutive down years on some of these charts right here. And the SEC doesn't always get good press, but I think the SEC probably, if you had to weigh it on a scale, I think it probably would end up with a positive weight attached to it.
Yeah, I mean, I just took a look at these three areas here. If you take away the pre-1940 figures, the number of years that ended with less than 10% actually shrinks to basically what you see here. So kind of cool. All right, we'll keep pressing on. All right, so back to, I guess I gave one more slide. This basically embeds our 10 most widely followed stocks by Manifest Investing subscribers. If you see the company name, you're actually seeing the performance. So like Ken was saying, if you had those top three, they could carry you pretty well in the previous year. And proud to say, I think I own all three of those, Ken.
Yep, me too. In fact, I own 4 and 5 on the top 10 list. I don't own 6, but I own Amazon, Google, Apple, Visa, and Stryker. So it worked out pretty well this year for us.
Yeah, so this just demonstrates how difficult this benchmark was to keep up with. Again, driven by much of what you see up at the top of this chart, those companies which were red hot that make up a big part of the NASDAQ or the S&P 500. But many of our companies fared pretty well. And this is, again, coming back to what Ken had to say a few minutes ago. Yeah, they didn't keep up with the market, but over the long term, these are great numbers for all of those, including our demonstration portfolios and the roundtable. And yeah, Buttonwood Bulls, just getting started. It's not even a year. Okay, anything else here, Ken?
No, I think it's good to look at this on a fairly regular basis and remind yourself that you don't need to hit a lot of home runs, but you do need a few.
They are fun when they happen. Speaking of home runs, the demonstration portfolio known as Tin Cup did actually reach 5 million for a few minutes on December 11th. And I have proof right here, straight from Yahoo Finance, that it actually happened, and proceeded to head for 4.4 million within a few days of that. Finished the month at 4.6. We continue to monitor it, but I am told by my colleagues that we don't get to count it until you actually close the month at 5 million. So we still can't count it yet. But
well, the market can be very humbling, Mark, and for the both of us, we've been humbled an awful lot in our investing careers. So,
and one of us here has this theory that the closer we watch, the worse we do. So maybe I'm guilty of that also. But this is a fascinating demonstration. It's basically taking and investing the maximum amount you could put into a 401k since 1995, and that has piled up to what is now approaching 5 million. I wish I could say that I actually had done that personally. If I could jump in a time capsule and go back, maybe I would. But life gets in the way sometimes too.
I will say, Mark, that this slide has just galvanized my grandson, who is 25 right now.
Mm-hmm.
And he is doing everything he can to come up with the maximums out of his salary to go into his retirement accounts, because this slide is his overriding goal in life. He would like to end up with this kind of growth when he's ready to retire. So you've galvanized at least one young man out there in the audience, and maybe more than that.
Yeah, we need a few more to catch on to that same type of thing, but we'll press on from there. Okay, here's the groundhog update. We do have, the reason the hourglass is getting smaller is we have less than 4 weeks left to go in this 18th running of the groundhog. And Jim Gallagher continues to, he was up around 3 million. He's down now in the 2.7 range, but I think he's pretty safe. And it has been a few weeks, so there's a little bit more turbulence in the standings, Ken. By the way, I was 60th or 58th. I dropped all the way down to 106. Ken went from 81 to 65. Kim was 41st. She's now 43rd, so she's just off the chart.
Yeah, but remember, 6 months ago I was in the top 10, Mark. So
yeah, it's been one of those years.
It's been quite a roller coaster year. And Matt, are you still tall?
I am. I one other fact. I'm 67% happier than I was a week ago.
Okay, great.
Because that's how much Luminar is up year to date.
And that's the part of Buttonwood, so we're happy along with you, Matt.
Well, Matt, I own Luminar, so I guess I'm 67% happier also, but I'm still way underwater. So
yeah. Pre-split, that's still 67 cents. So there's plenty more to go. But when Jensen Huang insinuates that you're in the party somewhere, then the partiers come to your table.
That's great. That's great. I do like it, Mark, that the clubs have reasserted themselves. We're up to 9 clubs in the top 40 again.
Yep.
The highest in the year has been 12, so we're at 9, and I see some clubs making some pretty large moves forward. The Antique Warehouse, which is a Michigan club, has moved into 17th place, and the B.I. Baker Club, which I belong to, has moved into 34th place. So I'm really happy to see those clubs moving on to the list, especially those with asterisks by their name. Welcome, Space Coast, to the top 40 again.
Yep. 2-time champions, and the Bar City ladies they don't leave the top 20, and it seems like they're always there along with the cool kids up there at number 6. Marie Frank, shout out to Marie. She has steadily moved up the list, and she continues to be in the top 3. So good stuff. Again, just a few more weeks to go, and I will remain hopeful that my highly leveraged selections will catch fire. All right. Like we said here early, a few more minutes ago, one of the things we are seeing, turn on CNBC, turn on any financial channel, they can't talk about this stuff enough. And this actually comes to us from Seeking Alpha. And they did a survey of what does their audience think are the best stocks to be considering for 2025. And the results of their poll is right there. I borrowed this from them just to make a point. Palantir, I do own shares of Palantir. Looking pretty good. I wish I'd have bought it the first time I thought about it, but into it because they have a pretty good position and actually deployed or implemented AI. And same can be said for Microsoft. I think Microsoft is doing some pretty good stuff. Broadcom has a pretty powerful customized chip family that is pretty highly regarded. And then, of course, there is the Thanksgiving Day table between AMD and NVIDIA. Ken, do you have any update on us on your girlfriend at AMD?
Well, I think that they've been taking a little bit of a back seat recently, but I still think that AMD is a very decent stock to own. It's down quite a bit from where it was 3 or 4 months ago. So maybe you want to take a look at it, folks. I still think it is playing in the right ballpark with the right products, and a lot of it's going to depend on execution. You know, how fast can they make these chips and get them out to potential customers? So I read an article just this morning, Mark, talking about the same kind of theme. It was the 5 best stocks to invest in, and I looked at it because it had PayPal on the list, and I know that Kim is very interested in PayPal, and another one of these articles is mentioning PayPal as one of the 5 best to take a look at for 2025.
Absolutely.
Cha-ching.
Yeah, their new management seems to be executing pretty well on the strategy, doing what they said they were going to go out and try to do. So ultimately, that can be quite rewarding. The other companies there are Google. I think Google is ubiquitous when it comes to these type of topics. Certainly a great holding. Um, Microsoft and Google are big parts of many of our demonstration portfolios. So just something to keep in mind. The last one on the list I am not familiar with, that is SoundHound AI. Relatively new company, but they do a lot of the voice activated stuff with vehicles of many different types. So might take a closer look at that one. The ticker is SOUN, fairly early stage, but a pretty extensive and distributed presence when it comes to talking to your frustrating radio in your car. Anything else you see here, Ken?
No, not. Let's keep moving here.
All right. As far as sources of other ideas, we have a long-term relationship at a distance, although I have met and I would consider him a pretty solid acquaintance, Eddie Elfenbein at crossingwallstreet.com. They have an ETF, ticker symbol CWS. You can see that they have, much like we would expect with some of those previous slides, Eddie tends to hang out in many of the more medium-sized workhorse type companies. And they had a little bit of a rough end to the year, so they closed down a little bit on the relative return since 2016, but the long-term picture is actually pretty good for this particular ETF. Here's a look at it over time. We do own shares of this directly in our family in one of our accounts, and we have owned it since the IPO, or since they launched this ETF. Again, the ticker is CWS for Crossing Wall Street. And I tend to think of it as a decent source of potential ideas for further study and contemplation. Here is a look at the list that he released on Christmas Day. It's the 25 stocks that this particular ETF will hold. I suspect that virtually everybody in this audience knows most of those companies. He tends to think like us. He tends to, frame his stock selection methodology in a very similar way, looking for good, solid companies, good fundamentals, and attractively priced. You can see, as it says in the box there, we've tracked his performance for 16 years now. Some of that actually predates the ETF, and he is ranked on our all-time list of best returns and has beaten the market 81% of the time. He didn't beat it this year, but 81% of the time for 16 years. What are your thoughts, Ken?
I like his list. I follow his list. I keep it as one of my portfolios that I kind of watch for ideas during the year. And to be honest, Mark, if you're an investor, a long-term investor, and you don't own 2 or 3 stocks on this list, then I think you've lost out on some really great ideas.
Yeah, we have owned Abbott and its successor companies since the 1990s. And there's a couple more on the list that fit that description. But this is
another one would be FactSet, Mark, that
oh,
has
yeah.
been an awful lot. And I've owned Heiko for about 15 years right now and been extremely happy with Heiko. I know you presented Muller Industries to the roundtable just recently, and there's our friend Stryker down there at the bottom of the list that I've probably owned for 15, maybe 18 years. So there's some really good long-term plays on this list, and just because I skip one doesn't mean that it's something that you should ignore. I think that all in all, he does a really nice job of collecting a very a diversified group of medium-sized to larger stocks. There's not a whole lot of really small ones on this list, but a really good list of medium-sized to larger stocks which can underpin a portfolio and really serve you well for a long, long time.
Yeah, if you're hunting for early stage companies or the next Luminar, this is not a place to go looking. This is much different than that. He likes established track records. Again, as I said, he tends to think very much like we do. These are the 5 new ads. It might be interesting to study those to see what they look like. This is a recent ad for the roundtable, and I do find this very interesting too. There are 2 companies on this list that touch straight into my heart and spinal cord, Aflac and Hershey. And this particular article, which you can access down here for free, actually proceeds to review his reasons behind selling those 2 companies. And it's probably a worthwhile look to see what is he thinking.
I'll admit to owning Aflac, Mark, and I'll admit that Elfenbein makes a compelling reason why you might want to sell it. He makes a very compelling argument to consider.
Yeah, and the counter argument to that I've heard made by our dear colleague, Hugh McManus, who's a pharmaceutical scientist, that if the cure for cancer actually materializes, he just with a wink and an Irish nudge says, what do you think that will do to the liabilities of Aflac, and how favorably will that affect their long-term balance sheet? And then he sneaks away and probably buys a few more shares. So there are two sides to that coin. I still own a few shares of Aflac. I
did start my sentence by saying I still own it. So
so I think it's compelling to see the rationale behind a decision like that by somebody like Eddie. Here's an actual dashboard which is available at the site in the forum, and just put together just to show you that we're not kidding, folks. I mean, look at the growth rates. We're basically talking about a workhorse right down the middle, 8-9% growth rate, high quality for the most part, pretty serious EPS stability, considerable financial strength, a little bit of friskiness there towards the bottom of the list. But again, as Ken has mentioned a couple of times, Mueller Industries was recently selected for the roundtable. And I'm pretty sure, Ken, that Stryker's been in his best buy list for all of the 16 years.
Could very well have been, because I've owned it for longer than 16 years, and I've been following Elfenbein's list for probably 9 or 10 years, and it's been on the list for as long as I've been following it. So,
and we tell, especially in investment club scenarios where you have stock watchers, Eddie can be a faux stock watcher for your club. I mean, you can actually access this same source here, and he will give quarterly dissertations on what's going on at the company that could actually serve a stock watcher well. So he can be a member of your team, partner at large, I guess, for an investment club. All right, here's your buddy Ken.
Yeah, I really like Tom Lee, and it was more frivolous than I've ever seen him when he named his new ETF the Granny Shots ETF. That I kind of didn't understand where he was coming from until he reminded us about Rick Barry, and suddenly I could see that big tall guy throwing that ball between his legs and throwing free throws for it. It was easy to remember. But again, a list of not necessarily really frisky stocks, but a list of really good, solid holdings that maybe if we were back 35 or 40 years, Mark, we would have called it widows and orphans stocks. What do you think?
Well, I'll tell you, from top to bottom, some of these are perhaps even a little bit over their skis at this point, but I wouldn't be afraid to slap this into a dashboard as a standing watch list and just watch for companies to become available at attractive prices. I do have an editorial comment. When was the last time you saw him with his hair combed that neatly on CNBC, Ken?
You mean Tom Lee?
Yeah.
I don't think I ever have.
He usually looks a little bit like playing the part of the mad scientist anytime I
Maybe he
see
had
him.
his publicist with him. And again, folks, I think you're looking at a list that if you find you're reading this list and you don't own 4 or 5 stocks on this list, again, you might have been losing out, and you should be thinking about why you don't own 4 or 5 from this list. When I go down this list, I can pick out 7 or 8 or 9 that I own, and again, they can form the basis of a good, solid, long-term portfolio. This is not the play money. This is not the early stage investing. This is not the Luminar or the Oklo or the Nucor energy companies. But these are great stocks to underpin the performance of a portfolio and keep it so you can make that 13, 14, 15, 16% on a regular basis.
Okay, so this is a relatively brand new ETF, and here's the ticker, Granny, GRNY. It's been around since the third quarter or November of last year. So these were all added to this portfolio at that time. These are stocks that have been on his Granny list in some cases for many years. But here's one of those AI companies that people have been talking about a bit that took a bit of a hit, operational hit mid last year. But this list actually comes from Y charts. But I did notice as I was setting up to do this that the Morningstar coverage at Granny, so you can actually take a look at the portfolio holdings from top to bottom at Morningstar now also. And what I will make part of my operating routine is to watch for any new company which bursts onto this list as the months roll forward. All right. Here's just a quick notification, something that I decided to start doing because we were leaving companies off the quarter or the earnings reports that are coming out on a weekly basis. This is this week's list, and I've decided to actually use our database as it should be used and cover them all. Basically, let everybody know, like just today, here's one that perhaps Ken would be very interested in knowing that they're reporting earnings today.
Yeah, I've owned this particular company off and on over the years, Mark. I do not own it presently, but I'm very familiar with MSCI, very familiar with it.
I'm talking about Simulations Plus is reporting today. So.
Oh, I thought you were talking about MSC Industrial Direct. Okay.
Well, MSC Industrial Direct is part of this current week's update, so I went ahead and showed that.
Right.
That's an active link to the update on MSC. So that's just
yeah. I still own Simulations Plus, Mark. Very interested in that company, and I still think it meets the criteria for which I purchased it in the first place. So it stays in my portfolio.
And I guess for me, it's kind of a personal philosophy of investing. I do not attend a lot of conference calls. I don't obsess over them. Maybe that's part of the reason I haven't published this list like this. I don't know. But I do think it's prudent to at least nudge yourself anytime one of these rolls by and see how they did versus what they thought they were going to do, what the experts thought they were going to do. So it's just kind of probably a good practice to check in on your company as these names roll by over the course of the year. It's not a New Year's resolution.
I want to step up on just a very short soapbox for just a moment and say that if you're in an investment club and you've been charged with watching only a single stock, you probably owe it to your club to listen to that earnings call. You don't have to listen to all the earnings calls of all the stocks your club owns or all the stocks you own. But if you've been charged with following a particular stock for the club, I think you owe it to everybody in that group, all your partners, to listen to that call, to take a few notes, and to ask yourself some serious questions. If you have questions about what's being said, you can always call investor relations, or you can always ask your partners, what do you think about this statement that was made, and then relate what the statement happens to be.
Okay, so again, you can find that on the weekly updates as you drill down into the earnings this week. section of the report. All right, we're not going to do any Buttonwood Bulls transactions here. This is the update as of today. Our January money has landed in the account, Ken, so we've got something to work with here.
Great.
Perhaps we can tinker next week with keeping this growth where we want it. And the quality is pretty good. Par could be a little bit higher too.
Yeah, that 13.8 is right in our wheelhouse right now, where we want it to stay. If we can stay between 13.5 and 15, I'll be very happy with this whole thing. And we do have a couple candidates with still at pretty low growth rates that we should probably take a look at. Yeah.
I do think if we surveyed our audience for AI ideas, this one might come up. It's been subject of a number of roundtables and bull sessions. This is actual deployed AI type activities, and these guys are good at it. EXLS, probably worth a look, or at least keeping it on your radar screen. Part of this portfolio. Okay, so we'll come back to that in decision mode perhaps next week. Here's a reminder that we do archive all of these sessions, bull sessions, and roundtables at the YouTube channel under Manifest Investing. If you subscribe, we will let you know anytime new content is added. I left this one in here because I got the question twice in the last 3 days over the phone. Anytime we talk about the sales growth, we're talking about the actual revenue or sales growth trend, as you see here by the red dotted line, no different than a SSG-based stock study. And it's not any one of those numbers up at the top of the page. It's that red line. Okay. We'll come back to this one in the future. Taking a look perhaps at podcast. We definitely want to take a look at that family, and we'll take a look at that. You may recall the Intuit or Quicken.com app that we had years ago.
I think it's a good time to repeat, Mark, that we are actually very serious about taking this program wherever you'd like us to go. So please share with us ideas that you might have, things that you think you might want to learn about or talk about, and we'll be sure to make an effort to move in that direction if it's something that we think we can put a decent conversation together about.
Absolutely. All right, so we're going to go ahead and close down with a couple of pictures. The one on the right is simply because we haven't had a hippo on this side at any time, Ken, and you know that we collect animals here. And
is this the new little pygmy hippo that was born, Mark?
It could be. I think we have to put San Antonio on the itinerary list, Ken.
Okay.
I've not been to San Antonio. We're going to need to get down there, so maybe on the way to Punxsutawney, we can swing by San Antonio sometime.
That's okay.
And the picture on the left is courtesy of one of those Bauer City ladies, Susan Michelik. That is not a current picture. It's from a previous year, but trust me, there's about a third of the country that looks like this right now between the Ohio and the southern part of Tennessee for sure. Beautiful, but can make travel and the delivery of electricity quite a challenge.
Especially with that heavy snow sitting on those very weak branches right there. So
it is a nice shot, but okay. And then there's for the guys in the audience, we are how many days until Valentine's Day?
Over a month. So don't panic until the 12th. Okay.
So everybody out there, forget I even mentioned it. All right, so I just love that friends don't let friends be average investors. Anything else, Ken?
We do have a question, Mark, that we could do a little bit of looking up of information about for the next time. Ben out in the audience would like to know what does the dividend actually add to the return of the S&P 500? I'm reasonably certain we can find that answer out maybe in your database. What do you think?
Oh, I know they can. I'm guessing over the long term, or at least the last 40 years, I would say 2%.
That my guess would be 1.5 to 3%. Yeah. So But Ben, we don't have the answer for you directly, but we'll see if we can come up with it at some point.
I noticed I did not review the article, but Josh Brown was out with a commentary, probably a bit of soapboxing about dividends just being a feature.
He was on CNBC with quite a session on it this morning, Mark.
Okay.
And basically the gist of what he is saying is that if you're investing in stocks with the sole purpose of trying to make money by the dividends, then you're doing it all wrong. The dividends have to be part of your strategy. And if you think it should be a reasonable size part, that's okay. But when that part becomes too large, then he has a lot of data that shows that you actually decrease your returns, not increase your returns. He says you have to be a little bit more varied in your style than just focusing on the dividend. And he says, especially when you're looking at companies that have an inflated dividend, that's usually a sign of a company in, well, he used 3 or 4 adjectives, but the one that comes to mind is turmoil. And you run the risk of that dividend disappearing or reducing itself to almost nothing in the relatively near future when that dividend begins to move higher. He says it's a sign of declining earnings when the yield moves higher. And I tend to agree with him on things like that. But he doesn't disparage dividends. He says they're a wonderful part of the investing journey. But he says you have to look at a number of things besides just the dividend when you're investing.
Absolutely. In fact, you just gave me Elaine Garzarelli chill. Elaine back, I didn't even know the year, basically said, I can remember it vividly. Kmart had a dividend yield of like 12%. And her words were, what could possibly go wrong? And you know, and now we know the rest of the story. So
yeah, was that being said in truth or sarcastically, Mark? Do you know?
well, the company disappeared from the planet not that long.
Oh, I
after
understand
that, so.
that part. Yeah.
No, she was serious at the time.
Absolutely serious. Okay.
You know,
Well,
victim of a deep value trap of immense proportions for sure. But very interesting. So yeah, I think if you look down this list for the amount of dividend contribution, you won't find much from top to bottom on this list. That doesn't mean dividends are bad. I think we demonstrate dividends pretty well with our utility bill auto pay portfolio.
Mark, I think Josh Brown summed it up by saying the same thing that we tell beginners a lot of times, that it's great to find a great stock that happens to pay a dividend. And of course, you want to take it and reinvest it in your portfolio. But if that's all you focus on, then you're probably doing the portfolio management part of your job incorrectly.
Fair enough. We'll just leave it at that. All right. So with that, we will be back a week from today with the next session for this year and have some fun along the way. Oh, I see Cheryl Smith is asking about our Cognizant 5-year ago proof. You know, I did do some work on that. I haven't forgotten you, Cheryl. We'll have it for you next time around. We were talking about the fairly highly trafficked, pretty well regarded session we had done on Cognizant a while back, Ken. And she was
I know what we're talking about. And she
Okay.
had asked us that question before Christmas. I do remember now. Yes. So we're getting a Happy New Year from Kathy Woods. It's not the Kathy Woods everybody else knows, but it's the Kathy Woods we know. So
Yeah.
Happy New Year back to you, Kathy.
All right. Well, take it easy, Ken. I'll chat with you about the migration concept and all that stuff offline.
Sounds good. Good night, everybody. Good afternoon,
All right.
everybody.
Take care, everybody.